Hello, everyone. Welcome to today's webinar, Practitioners' Insights. Learn more about quantitative approaches to valuation and portfolio construction. I would like to take a moment to welcome our audience from around the world joining us remotely. Grenold and Kohn, a fundamental law of active management, expresses it as a function of two things, skills and breadth. In today's webinar, we will explore both these aspects. Skills in terms of how practitioners could use alternative valuation techniques to come up with fair value estimates for companies, and breadth in terms of how do you express those fair value in your portfolios in terms of position sizing. My name is Sivanand Ramachandran. I'm a Director of Capital Markets Policy in CFA Institute, and I will be your host for today's webinar. In my role, I look after research and advocacy for CFA Institute in the Asia Pacific region, and the role involves coming up with capital markets positions in a variety of issues such as corporate governance, ESG, and pensions. Before I introduce our speaker, I have a couple of housekeeping items. Today's webinar is scheduled for 60 minutes, including Q&A. We will spend about 35 minutes or so for the presentation, followed by the Q&A session. We'll be leaving adequate time for Q&A, so please feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A button at the bottom of your screen and submitting your question in the box. The webinar presentation will be available to view after the presentation concludes in the chat box. And we value your feedback, so please complete the evaluation survey before you sign off today. Now, it is my pleasure to introduce today's speaker, Sharad S Ramnarayanan. Sharad is the appointed actuary, New India Assurance Company Limited. He is a qualified general insurance actuary working currently as appointed actuary at New India Assurance. He completed his chemical engineering at ICT Mumbai and his postgraduate diploma in management from MDA Gurgaon. He is also a certified financial risk manager from GARP. Before joining New India Assurance Company, Ramnarayanan worked as an investment professional at Birla Sun Life Asset Management Company, and before that, Parry Washington Company Advisors and Tactica Capital Management. He also worked as a finance professor at the Asian School of Business. He has authored 2 books, one of which is on this topic, Quantitative Value Investing, a Practitioner's Approach to Stock Valuation, and a second book on retirement, Retire with Dignity, Do-It-Yourself Retirement Guide for the 40 plus. Professor Sanjay Bakshi is Ramnarayanan's teacher and mentor at MDI and had a major influence on him in his investment journey. With that, I welcome Professor, I welcome Sharad, and I give the stage to him to go through his presentation.
Yeah. Thank you, Shivanand, for the very kind introduction. So my topic for discussion today is about some quantitative approaches that can be used for valuation of stocks, and also a few quantitative techniques that can be used in terms of portfolio construction. So let me begin the presentation now. My standard disclaimers, of course, it's there in the presentation. It's available for download at the end of the presentation, so I'm not going to go through it. When it comes to valuation, I think almost all the investment ideas, finally the rudiments of investment return, primarily can be summarized into 3 aspects. So one, of course, is the return on equity of the business, whatever is the business which is underlying the stock. So what is the return on equity that the business generates? What is the earnings growth that this business can produce? And finally, what is the price at which you are buying it? I think most of the investment opportunities which are available, I think it can be summarized into these three important fundamental pillars. So any valuation approach which can be used primarily needs to incorporate these three pillars. And one of the simplest and most useful one as valuation model that can be used for here, I think all CFA students definitely, and CFAs are all very comfortable with this model, is the price to book model of valuing the mature growth companies, which is given by this ROE minus G by your R minus G, where R is your required rate of return. So if you are not comfortable, some people are not comfortable with using price to book value, so they prefer price to earnings. So in that case, the formula is slightly modified as ROE minus G by ROE into ROE minus G. So this is something which is very, very basic. Even though I say that quantitative approaches which are non-DCF based, but finally, if you look at the underlying derivation of these simple equations, they again go back to some kind of the Gordon growth model or the dividend discount model or something like that. So my preference, of course, is for using the price to book value model because of two things. One, of course, when you use ROE, it has very nice mean reverting characteristics. It has been shown time and again that ROE exhibits a very nice mean reversion over time. And second is that the price to book value of a company is far less volatile when compared to probably price to earnings. So on the right hand side, what I have depicted is the ROE of Nifty from 1999 to 2023. So you can see there are bouts of optimism, bouts of pessimism, but finally it sort of reverts to the mean. So here, if you see for this data set which I have used, the ROE has hovered between 9.69% and 28.22%, and the median ROE has been around 16.9%. Similarly, price to book value has hovered between 1.92 and 6.55. And the median, if you take, is around 3.52. So I made the slide on 4th July 2023. So I'm just quoting the data as of that particular day. The ROE is around 22.59% and the price to book value is about 4.54. So this mean reverting characteristics of ROE, I think, is there not only for the index, but also for all the businesses. So which makes a model which involves the ROE, earnings growth, and the price to book value quite useful. So when you come to the denominator, there is this the required rate of return, which you can call it the cost of equity also. But basically, what it effectively tells you is the return that you make if you buy it at fair value and allow it to compound. So how to arrive at it? If you go the academic way, then you have the capital asset pricing model, which is basically risk-free rate plus some Greek and Latin, which really don't matter as far as practitioners are concerned. But the simpler ways of arriving at your required rate of return probably is to look at what the Nifty, it's the next best alternative. Instead of looking at buying at stocks, you can look at buying the Nifty and just forget about it. So a Nifty total return index, what is the CAGR over the last many years? That I think is a good indication of the bare minimum required rate of return. Or you can say that my risk-free option is the government bond yield. So I want so many times more than the government bond yield. You can put it as 1 plus X times. But again, if X equal to 1, you say it's about twice the government bond yield, which is the kind of approach which Ben Graham always advocated. So you go for twice the government bond yield. So the advantage with this approach, of course, is that it automatically adjusts. Where in high interest rate scenario, your required rate of return actually increases. Low interest rate scenario, it automatically comes down. So that is the advantage of using a multiple of the government bond yield approach. And you can also, the governments are these days acting quite crazy. So there are many times when the real rates actually become negative. So in those kind of situations, you may even use a multiplier of the inflation as the required rate of return. But whatever be the approach, what it essentially tells you, the required rate of return is this is the return I want. right? So I'm not a big fan of using the capital asset pricing model because it's and which gives a different required rate of return for different stocks. Because finally, when you want to buy something, you want to buy a Domino's pizza out of the money that you have made in stock market, you are not going to get a discount because you have made the money in HUL, and you are not going to be charged a premium because you have made the money out of Tata Power or something like that, which has got a high beta. So the basic thing is whether your required rate of return, it should be something which is reasonable. If you want a very high rate of return, then what happens is you may end up losing out on a lot of opportunities. And if you are having a number which is too low, then it means that you may end up overpaying for the stocks. And the basic fundamentals about ROE is whenever the ROE is more than the cost of equity or the required rate of return, you can say it is the capital expenditure or more money which is invested into the business. It creates more value. When the return on equity is equal to the required rate of return, it means that the growth is kind of immaterial. And when it is less than the required rate of return, then they keep on reinvesting the money into the business. They eventually end up destroying value over time. So coming to the mechanics of return, so what it essentially means is, suppose you have taken a required rate of return 12%. What it essentially means that every year, if the company keeps on delivering as per your expectations, you keep making, and you have bought the stock at its fair value, you end up making 12% every year, right? So here, I am just giving an example. It's that a company is there which is making a return on equity of 16%, and it has got an earnings growth of, say, 8%. So at the start, if the capital is 1,000, you expect it to make, say, 16% return with 8% growth. So the price to book multiplier becomes 2 times ROE minus G by your 12 minus 8, 16 minus 8 by 12 minus 8, that works out to 2. So the fair value for this particular business for the capital is you have paid 2 times. So the fair value is, say, 2,000. Now, the return that the business generates is 16%, which means that you generate a PAT of 160. Just to sustain this particular growth, again, you go back to the academics textbooks. It says that the payout ratio is your ROE minus G divided by ROE. So which means that to sustain this particular growth and particular ROE, the company needs to probably pay out 50% of its earnings in the form of dividend. So you have the dividends which are paid, which is around 80 out of 160, 80 is paid, and the remaining capital is 1,080 at the end of the first year. Again, you have the expectation of the 16% ROE getting continued. So you pay a fair value of 2 times 1,080, which is 2,160. So like that, you see that the capital actually compounds at 8% in line with the earnings growth. And your dividend that you get, which works out to about 4% of your capital. That's so that together you get that 12%, your 8% through capital appreciation and 4% through dividend. So anything and everything that affects the sustainable ROE or the earnings growth profile, it has got an implication on the fair value. So the most important thing that we need to see here is that the fair value is not a stationary number. Many times what happens when we look at a particular stock, you get anchored to a particular number that this is the price at which I want to buy it. But even after 1 year or 2 years, the business fundamentals would have changed, but we are still anchored to the old price at which we really saw the stock. So this is something which is important, because when you are estimating the fair value has to reflect the underlying business and how the business has developed over time. It's not like you look at it at a particular point of time and later you are sticking to that same number and waiting for that number to come. So this fair value is a moving target. It's not something which is stationary. That is pretty important. So whether you are buying a stock or selling a stock, the assessment of fair value needs to happen right before the action that you are going to take. In case this is the basic approach, in case you want a more rigorous approach, I would like you to read Accounting for Value by Stephen Penman, because there is another way to look at it is to go for a residual earnings growth model. So in residual earnings growth model, Penman argues that any growth which is over and above the cost of capital only starts accreting value, and that only deserves a higher price to book. So that kind of a detailed approach is available. So but it just makes the calculations more rigorous. This model itself is reasonably good enough to work with, but for people who are more interested in a more rigorous approach, they can definitely check out this book. So another important pillar that I said was, what is the price at which you are buying? Right. So the price actually, the entry price actually decides what's the return you make. Other than the business fundamentals, the third important pillar was, what is the entry price? So I take the same example. We said that a 16% ROE business with an 8% growth, the ideal price to book to pay probably is about 2 times the book price to book value. And if you pay 2 times price to book, you end up generating a return of 12%. But you are in the market to actually get a return which is more than what is your required rate of return, minimum required rate of return. So here I am giving you two situations. One where the entry price is actually 1.25 times the price to book value. And in the second case, the entry price is 2.75 times the book value. Over a period, say the price actually gravitates towards its fair value. So if you assume that for the illustration purpose of illustration here, that the price to book reverts to its fair value after 3 years, the return that you generate, if you actually invest at 1.25 times book value, is probably around 32%. I'm just taking the IRR of the return. And if you actually buy it at 2.75, the price actually gravitates towards, price to book gravitates towards 2, you end up literally making nothing. So this, I feel, is a very, very painful thing. Like if you actually invest in a company, the company does badly, or the company does some harakiri and finally you lose money, you don't feel that much because it's an error in your judgment of the business. But in the second case, what is happening? The business is delivering as per your expectations. The company is growing, the company is earning, the company is paying out dividend. But because your entry price is on the higher side, you eventually don't make any return. So your expectations about earnings, the expectations about dividend payouts, everything has been matched. But if your entry price is on the higher side, you eventually make very, very suboptimal returns. And this is what happens actually. In fact, about 3-4 years back, there was a school of thought which says, for a very, very high quality business, the price to earnings multiple doesn't matter, the what you pay doesn't matter, eventually everything will be taken care of. So like that, there were practitioners who were telling such things. But what we essentially need to understand is, for every price to earnings or every price to book that we pay, there is an underlying set of assumptions on the expectations on how the business delivers. Higher you pay, the more is the expectations which are built in. And whenever a good quality business actually generates what is expected of it, but the stock doesn't generate a return, it definitely makes the situation pretty painful. Right. So there are schools of thought which says that quality businesses require a higher multiple. But what if you are actually using the numbers, that quality is actually reflecting in the numbers in the form of its higher ROE, in the form of its earnings growth or whatever. So as long as the numbers or your expectations are accounted for, on top of it, if you want to pay for quality, you are eventually double counting it. So you don't really want to double count on something and pay higher. So this is just an example of what happens when you end up overpaying. And this is precisely what Graham and Buffett and all, they advocate about margin of safety. So margin of safety allows you to buy, you are asking, they are asking you to buy at a discount to the intrinsic value. And that discount serves two purposes. One, when the price converges to its fair value, you make returns much higher than the required rate of return. And second, when your expectations go wrong, this the fact that you have bought at a discount to book your fair value actually helps you to cushion the impact of a negative movement in the stock price. So that's margin of safety serves two important things. So which makes it imperative that you need to assess the fair value and try to buy at a discount to your assessment of the fair value. I'll spend some more time on the issue of capital allocation, because we said that return on equity is an important pillar as far as the returns are concerned. But the return on equity depends again on the quality of the two things. One is the quality of the business and the nature of operations. And second is the capital allocation policy. And it is found that it's much easier to understand the quality of operations and its impact on the ROE. It's much easier to understand the dynamics of the business. But the impact that capital allocation has on the return on equity that a business generates, it is equally critical, I would say, and it has got a huge role to play. So whenever there are good companies, very good operations, but they have poor capital allocation strategies, there also the return suffers. So if I want to quantify it, I'm just giving you another example here. We saw in the earlier example, the same company, which has got a 16% return on equity, 8% growth. We said that it needs to pay out at least 50% of the earnings in the form of dividends, which eventually takes your fair value to 2 times. Now, if the company has a capital allocation policy which says that only 25% is what will be distributed instead of 50%. Okay, so you are saying that for the theoretically 50% should have been distributed, but the company distributes only 25%, which means the company is reinvesting much more than what is warranted. But it is not reflected in the earnings growth. Earnings growth continues to be, say, 8%, because if you are reinvesting more, obviously the earnings growth has to be much higher. But if the earnings growth doesn't change and the company decides to distribute lesser than what is warranted, then let us see what is the impact on the fair value. So here we see that in the first case, the company was paying, say, 80 in the year 1, the company paid 80 rupees as dividend. In this case, the company is paying only 40 rupees as dividend in year 1. Now, you start with the expectation of, say, 16% ROE as a sustainable ROE. So you end up paying, say, 2 times price to book value. But since the company has paid only 25%, the return on equity, expected return on equity for the next year, it actually comes down from 16% to 15.43%. And again, the year after that, it comes down to 14.93%, and then it goes to 14.5% and so on. So with progressively decreasing ROE, what is happening is the price to book multiplier also starts coming down. So in year 1, the price to book actually contracts from 2 to 1.86. So the fair value moves from 2000 to only 2080. In the earlier case, when 50% was distributed, the value was 2160. Here it is only 2080. And the difference between the fair value in the first case and the second case is 80. In year 2, the difference in fair value actually increases from 80 to 166. In year 3, it further increases from 166 to 260. And there is a relationship. This is actually, this 80, 166 and 260 is the kind of value destruction which is happening to the shareholders because of poor capital allocation. Everything else remaining the same. This is the value destruction which is happening because of poor capital allocation, right? So if you actually look at this number, this 80 in the first year, the extra retention was 40. You were supposed to distribute 80 as dividend, you distributed only 40, so 40 was retained. So the extra retention was 40. In the second case, the extra retention, the first year is 40 and second year is 43 is the extra retention. So that is 83. And in the third year, it goes to 130. So if you take it as a ratio, the ratio between the fair value under normal circumstances and a fair value with a poor capital allocation, if the capital allocation is as per this slide, is 2 times. Right? For those who are theoretically inclined, we can prove that this ratio between the capital, which is there at the ideal circumstances, to the ratio with poor capital allocation is given by G by R minus G. Right? So here your growth was 8%. Your return was required rate of return was 12%. So 8% by 4% is 2 times. So this 2 times actually comes from the G by R minus G. Okay, and what will happen to the ROE? The ROE is continuously decreasing, and eventually this ROE, if the same dividend payout policy continues, the company will keep on accumulating cash. And I am not assuming any interest out of this cash accumulated and all for the purpose of illustration, just to show the importance of capital allocation to ROE. So eventually this ROE will converge to 10.7%. right? So what is happening? We have an operating business which is generating an operating ROE of 16%, but poor capital allocation can eventually make this company into a business which generates only 10.7% ROE. Now, when you encounter companies like this, how do you actually value them? Right? There are 2 or 3 different approaches. One, of course, you can assume that it will be converging to the lowest of the ROEs over a period of time and then see whether this is what I'll pay. Or you can calculate the operating ROE where you strip the assets from operating assets and investment assets and you see what is the operating ROE, what is the remaining, and that excess capital based on your own assessment of what is the probability that it will be eventually distributed, you can add a value. So that is one way of doing it. So here you see that if I calculate the IRR the same way that I did earlier, the IRR for this particular company works out to only 6.23%, right? So we assume that the company will pay out as much it should be paying out, which is 50%. At that time, the company was expected to generate 12% return, but slashing the dividend payout from 50 to 25% has resulted in the return coming down to 6.23%, which essentially means that the single stroke of capital allocation policy is what has eaten away 50% of your returns, right? So a lot of focus of investors is on the operational quality of the business, what is the modes and what is it that the business is doing in terms of sustainability, all those things people look at it, but how good or bad is the capital allocation is something which has an equal bearing on the returns. And this poor capital allocation, it can be due to either lower dividend and letting the cash accumulate in the balance sheet, or worse, you do mergers or acquisitions at inflated prices. Just imagine if there is a cement company which is valued at say $75 per ton or something, and it goes and acquires another cement company at $150 per ton fair value, then this is a classic example of poor capital allocation, because a buyback would have been a much better option for the shareholders, because then literally you are buying into cement assets at $75 per ton. Now, it can also be that they enter into lines with poorer ROE profile, because there are lots of entrepreneurs. If the entrepreneur who is successful in one line, often he gets a kind of false sense of confidence that he can get into anything and everything and he will be successful. So many a times they get into something and their ego doesn't allow them to actually come out of the poor ROE profiles. So if you have a good ROE business where money is being pumped into lower ROE business, that also is a big driver of your returns.
Got it. So Sharad, I think this example also reminds me of Indian IT companies. I think last few years they went on a like sort of an M&A to kind of drive up their growth, and it seemed as if that strategy had not worked. And now they have resorted to buybacks and dividends, and and the valuations have moderated in some of these companies. And I think to your point, investors have responded by moderating, like paying less for per rupee of earning compared to what they had paid before, because the dividends and buybacks were a kind of a signal that look, maybe we can't buy our way into growth through acquisitions, right?
Absolutely.
And I think to what you mentioned about maybe it makes sense that they need to kind of strip out in the new normal what's the operating ROE, and what is the right level of this thing, and maybe what their companies are doing is the right thing, right? So but they also need to communicate that what's the sustainable level of growth, right? So for investors to understand and discriminate between good growth and bad growth, right? So to speak.
Absolutely, absolutely. In fact, off late, there are so many companies who do conference calls, I always like listening to the audio transcripts of the con call to see how the tone of the management when they respond to questions on capital allocation. It's a real giveaway as to what exactly they plan to do. They are very, very vocal about operations, but when it comes to capital allocation, many of them are trying to either avoid the questions or they don't want to really communicate too much, or they say it's a call which the board has to take. So the message really doesn't go out. So the shareholders definitely, based on available information, they need to take a call, especially when it comes to the not so large cap companies, where the entrepreneur still holds fort. So those are some of the instances where But at the same time, on the flip side, if you see, when companies actually go in for a change in capital allocation policy, they really make you re-estimate a lot of your expectations. So this, I think, is a very, very fertile hunting ground for new ideas, because a company has been following a particular policy, and then one fine morning they finally take the board's approval and come out with a new policy that this is what we are going to do. That, I think, results in a huge change in the expectation. So these are some of the instances which are a very, very fertile ground, because operationally they may be perfectly priced, but capital allocation is what is pulling the valuations down. So the delta that comes because of the change in allocation policy, that creates quite a bit of opportunities for investors.
Thank you.
So I'm just giving a simple case study. It's a small company, but just for the purpose of illustration, I just given the financials of this company over the last 10 years. So especially after 2016, you can see that the company has been performing phenomenally well, and the margins have been pretty good. But if you see their profits, they have been growing consistently. But what is interesting is what happens in the balance sheet. Along with the increase in net worth, you can also see how the increase in investments is happening. Right. So from 2018, they had some 108 crores of investments in their book, which has gone up to 446. So this actually tells you what exactly they are doing. So just as a thought exercise, what I've done is I just split this company's earnings into two. What is the operating earnings and what is the non-operating part of the asset? So operating earnings to operating assets gives you the operating ROE, the approach which I said earlier. You look at what the core operations are worth, and then you also see what is the reported ROE. So you see that this company's core business is generating close to 30 and between 30 and 40% kind of a return on equity. And the reported ROE is consistently coming down, because so this is the classic example of a company where capital allocation is actually pulling down the valuations. So I have also plotted the price to book value chart of the company, almost trying to match what has happened over the last 10 years. And you see that at one point when before this huge cash accumulation binge started, the company's valuation had gone almost as high as 5 to 6 times the price to book value. But finally, now the market seems to reconcile that whatever said and done, this guy is not going to give out the cash. And the return on equity over the last 3-4 years has been around 19, 18, and 17%. And the price to book value has also come down somewhere between 1.5 to 2 times. The median price to book is around 2 times, which probably gives an impression that if you see the past earnings growth, you can see the company's earnings are growing at a CAGR of say around 6%. So probably around 18% and 18% ROE and 6% earnings growth is the kind of expectation that seems to be built into the market price currently. So this is these are the kind of companies where we have to be pretty careful, because suppose you look at, say, the numbers in 2017 and you find that the reported or 2016 or 17, where you find a very high reported ROE and assume that this kind of an ROE is sustainable, which the company has indeed sustained, but that sustenance has not led to corresponding value creation for the shareholders, because the entire money which has been generated is simply sitting in the balance sheet in the form of cash. So that is something we need to be wary of, because having a clear understanding of what the capital allocation policy is going to be has a pretty big bearing on the kind of ROEs that the company will eventually generate. And as long as we are holding a non-controlling position, there is nothing much we can do. Either you accept what is being generated, or you just look for better opportunities. So whenever I look at the various investor presentations, something which always attracts me is how much importance they have actually given to this capital allocation strategies. So I just given two snapshots found in two investor presentations, nothing to do with any kind of recommendation. I continue with the disclaimers, but how much importance they are giving to capital allocation in terms of their discussions in the con call. So on the right side, I just found in one of the transcripts a very, very funny response to a company. This company had a 600 crores of net worth, and they came out with a 20 crore rights issue at 5 rupees a share. So, and at the end of the whole exercise, the promoter stake increased by 2.3%. Somebody asked them why you are raising 20, it's not much of debt, so why you are raising 20 crores in form of equity and issuing shares, and why you want to dilute. So the response from the management was, you are not the managing director of the company to decide whether I should take debt or equity. So we find managements like these also. We also find managements with talk about capital allocation, how much they have generated, what they retained, what did they do with the retained money, how much they plan to distribute, and like that. So they are there. And it's very interesting that you find several companies in the same sector behaving so differently. Like, for example, in the media space, there are two companies which compete with each other in the to actually distribute the money to the shareholders. It could be in the form of dividends or buyback. There is another company which doesn't do anything for 5 years, accumulates a lot of cash, and then one fine morning they just distribute all the cash. Then there is another company, come what may, they are not willing to distribute cash at all. This company sells below cash, and this market cap is less than cash. So you find all sorts of companies within the same sector. The business dynamics are more or less similar, but they all have very different the way the market actually rewards these companies are all very, very different manner. And it all happens mainly due to the capital allocation strategy of the company.
So Sharad, we are getting a few questions.
Yeah.
So I think one question is more clarificatory. The question is, can you just repeat how we calculate operating ROE? I think that question comes up like a bit.
Yeah, I'll tell you. So this in this particular example, what I have done is I have a net worth, and then I have on the asset side I have the cash and cash equivalents. So the company doesn't have any debt as such as far as this company is concerned. So what I am taking is the net worth, which is not explained by the investments, that I am simply taking as the operational assets. And the pure cash and investment, I am taking it as non-operating assets. And again, readjusting the profit and loss statement, what I am doing is I am taking the PBT, I am subtracting the other income, and then imputing the corporate tax rate on it. So I get the operating PAT. So I have the operating PAT, and I then divide it by the operating assets to arrive at the operating ROE.
Understood. And a related question is, so how do so one option is to compare the operating ROE with the reported ROE and see the trend. The question is, can we also look at generally if the company's cash balance is going up with constant ROE, or the company's cash balance is going out with constant dividend payout? Is that an indication that there is a capital allocation problem in the company, right? So just how do you sieve out poor allocation?
Yeah. So what happens is when you have cash balances which are going up even with a constant allocation strategy, if cash balances are going up, then probably it means that your distribution is probably on the lower side. Unless you are able to convert this cash into some useful assets, it can be even inventory for that matter, or in case of agri companies, it could be inventory, or in case of other companies, it could be some kind of fixed assets, or even in case of acquisitions, if the acquisitions are value accretive. As long as you are able to convert the cash flows into some kind of assets, which in turn contribute to earnings, right? Because we are saying that our required rate of return is 12%. And this asset is going to earn you what 6 or 7% max pre-tax. So, so 12% also, if I take pre-tax, then what you are saying is 6 to 7% is the return this particular asset is earning. So we already said when your ROE is less than your, if the return is less than what your required rate of return, there is a value destruction. So that way, if you see this particular strategy, probably cash balance keeping on increasing, and they are not willing to pay it out, then obviously it is a case of allocate distribution lesser than what is warranted. And the ROE remaining constant means the operations are even doing better. Because if your cash balances are increasing and your ROE is also remaining constant, it means that your operations are even becoming better by the day. So, those.
Thank you.
So these are just for the purpose of illustration. I'm just putting a few examples of the change in capital allocation strategy. First one is a major two-wheeler company which said, I want 15,000 crore. Over and above that, anything which comes 90% I will distribute. Then we had ITC, famous for putting money into all and sundry kind of businesses. But suddenly one fine morning, they decided 80-85% of PAT is going to be distributed to shareholders. There is also a very interesting chemical company, small company, around 800 odd crores of market cap. That company had accumulated around 200 crores of cash, and shareholders were bombarding him with questions on what he is going to do with the 200 crore cash. He didn't want to really give it out. So what he has eventually done is, I want this 200 crore, I will convert this, I will put this into a new company and demerge the company and again get it listed. You will all get a share of that company. Right, and whatever you want, you can either sell it out or whatever, but that's another way here distributed. So probably this is an example of a case where how much you value the non-operating assets. You can value at zero, you can value at some 50% or 60%, or you can value full, depending on your view about what the management is going to do. So in this case, probably you will feel that it will list with a holding company discount of say 50% or 60% or something. So you put say 40% of the cash as your value that you can realize from it. So each company behaves in a different manner, and case-to-case basis, we'll have to take a call as to what is a good number you can put to operating assets and what is a good number you can put to the non-operating assets. So this is again, most of you, I hope, would have read this. It's a wonderful book on capital allocation strategies of 8 CEOs, what all they did in terms of. So the best part about this book, it doesn't talk about the quality of operations, but the value which was created by simple capital allocation strategies, which was used to deliver value for the shareholders. Quite a few examples, very wonderful read. Now, I just extend the earlier model now, because till now we are talking about a kind of a mature company where for which you can apply this model ROE minus G by R minus G. It's you usually apply it to reasonably mature companies, because for this model to work, you need the required rate of return to be greater than your expected earnings growth. So there are many companies in India where earnings growth is expected to be much higher. So like say, for example, if you have taken R equal to 12%, there are companies which will be able to grow earnings at a rate which is higher than this 12% for quite a bit of period. It's not that it can go on till infinity. You cannot project something theoretically. You cannot have a company which can grow more than your cost of equity till eternity. So you can use a multi-stage model. Here I am just using a simple two-stage model for the capturing this growth. So here I am just changing the nomenclature a little. That small g stands for the supernormal growth. That is the growth which is higher than your required rate of return. So your I am putting the mature growth as g dash. So you have the mature ROE as ROE dash and mature growth as g dash. And n is the number of years for which you are expecting this particular earnings growth, right? So this particular model results in two terms, the first term and the second term. So the price to book is an addition of two terms. But again, when you start putting numbers into it, you will say the academicians won't allow you to do away with both the terms. But when you put numbers into it, you see that the second term probably contributes 80 to 90% of the total value of the price to book based on this model. So as a practitioner, it becomes easier for me to discard the first term and come look at only the second term. So what is this? So if I take the second term alone, what it essentially boils down to is you have the same mature growth model, ROE dash minus G dash by R minus G dash. On top of it, I am going to give a growth multiplier. And that multiplier works out to be 1 plus G dash into 1 plus G by 1 plus R all to the power of n, where n is the number of years for which you want to model the supernormal growth. It can be 10 years. It is based on your comfort level. It can be 10 years, 5 years, or 15 years, 20 years. If you are that confident, you go to 15 and 20 years and all. But n is the number of years for which you want to model the supernormal growth. So what happens is, it's much, what I have found is it's more difficult to model the growth as such. But if you, I got inspired by the book Expectations Investing by Michael Mauboussin and Rappaport, where they say that every company at every price, there is an expectation built into it. They call it the market implied expectations. That book primarily deals with how to superimpose a market implied expectations using a DCF model. But if I borrow the same principle and put it into this particular model, and I have a closed form solution for the growth G, then I get what is there on the right side. This G equal to price to book value into this particular expression which I have on the right side, right? So what it essentially gives me, the price to book value is a number which is available in the market. For every stock, I have a price to book value available in the market, and I have a growth which is implied. Like if it is a 10-year period, if I am assuming a 10-year period, then for that price to book value, what is the 10-year CAGR earnings growth that this particular price has built in? And then we can actually compare the number which you have obtained with what is the past track record, what is the future expectation, and then see whether this particular number meets your target expectations.
Right. Sharad, just a comment on that, right? So I think to some extent, there are some companies and some industries where terminal value becomes a big portion of your fair value, and therefore it becomes difficult to estimate earnings growth for some companies like infrastructure, for example, where terminal value can become a big portion of your fair value. So I can imagine that what you mentioned about expectations investing is potentially applicable in those kind of cases, right? So it's difficult to estimate earnings growth per se, but you can obviously compare what the market is implying and compare with whether and make some presumption about whether that number is reasonable or not.
Yeah, absolutely. And the advantage here is we are actually relying on the earnings. We are not looking at the cash flows. In DCF, when you are looking at cash flows and you take an infra company, almost 80-90% of the value will be some coming, say, after a 5-year or a 10-year projection, you have a terminal value which is coming in. And it's so difficult to actually model negative cash flows for 10 years and then put a negative free cash flows for 10 years and then put a terminal value. Whereas here, since you are actually looking at earnings growth, that model actually works to that extent because the company is growing, it is reinvesting. So free cash flow model actually penalizes companies which are reinvesting. So here you have the advantage of selecting a company is the first thing. As long as you are comfortable with the quality of the earnings of the company, you can actually use earnings as a guide to arrive at the market implied expectation. This is where it actually, the model slightly deviates from the usual DCF model.
Thank you.
So this is a book which I was talking about, Expectations Investing, just in case you haven't read. So I am just giving you a simple example. I've taken a blue-blooded growth stock, darling of a lot of mutual funds. I'm not naming it, but this is the performance of the company over the last 5 years, for example. So the earnings, the sales has grown at a CAGR of 15.3%. Operating profit had a CAGR of 18%. PBT had a CAGR of 22.6%, and PAT CAGR was 26.5%. I won't really seriously look at PAT CAGR because we had a finance minister factor coming in between when the tax rates were slashed. So I think profit before tax 22.6% is probably a number you can really look at. So the question, of course, obviously, when you have sales CAGR at 15.3 and the PBT CAGR at 22.6, the obvious question is how long can this kind of a growth faster than sales continue? That's a question, of course, that immediately pops into your head. Now, this particular stock, let us assume that it's available at a price to book value of, say, around 8.9 times. So what exactly does it mean? I am going, the price to book is 8.9. If I make an assumption for the last 3 or 4 years, the ROE has been 27, 23, 19, and 23. Let me assume that as a shareholder, I am comfortable with the assumption that the sustainable ROE of this company is, say, 24%. I stick to my required rate of return of 12% and a mature growth of 8%. So I really want to see over the next 10 years, what is the kind of growth that the market is implying here. So I am taking n as equal to 10. So I'm just plugging all these numbers into this growth G expectation, which is there on the right side. So when you calculate this, you end up with a number, say 20.4. I am saying that the market is building in a 10 years earnings CAGR slightly less than 20, even though I got 20.4 because I have ignored the first term, if you remember from the formula which was there in the previous page. So I have ignored the first term. So I am saying that the market is probably building in an earnings growth slightly under 20%. Now the question is, again, it comes back to you. The market has told its verdict. Mr. Market has told you that this is available at 20.4% kind of 20% kind of an earnings CAGR over the next 10 years. After which I assume a mature kind of a growth and ROE of close to 24%. So now the question is not what you are expecting. You just need to see whether this assumption is reasonable or not. Is it achievable, right? Or is it putting an arrow at the end of the line? Because Taleb has said that human beings have a tendency, whenever they see an arrow, whenever they see a line, they put an arrow at the end of it. So this is now a time where market has told you something and you need to challenge your conviction, right? And finally, also be aware that your required rate of return is 12%. So even if the company grows 20% over 10 years, you are going to generate 12% return only, right? So the question is, if you want something more than 12%, the expected earnings CAGR should be more than 20%. So that is what the market has offered to you. And that is the assumption that you need to challenge. So how do you challenge this expectation, right? So let us look at what the earnings growth has been year-wise. So 2020, the earnings growth was 53%, 21 was 16%, 22 was 3%, and 23 again is 40%. And you also see what the price to book value has been in the past. And you see that thanks to the wonderful tool called Screener, I don't really have to do the hard work of finding all these things out. A big shout out to them. So you see that the median price to book value for this company has been around 6.4 times. So what does the 6.4 median price to book imply? You again plug it back into the same equation. It says that the expected earnings at median price to book value is a 16% CAGR. You see the sales growth of 15.3, you see the earnings growth of 16% CAGR as the implied expectation. You say it is something more like a normalcy. Now, the question is, if the stock is available at 8.9 times and your expectation, you'll have to increase it to something more than 20 to generate something more than 12%. So the stock has got re-rated. Now it is up to you. It is your understanding of the business which will actually decide whether you want to buy, sell, or hold the stock at this particular valuation. So if you are confident that there are structural changes in the industry because of which the operating margin is going to go up, the ROE can probably go up, or the earnings can probably be higher than 20, obviously this is also a buy price. And just for information, after making the slide, the results came and the stock is now available at more than 10 times price to book, right? So it was a blockbuster results. So but the question is, what is your expectation? And if you are too conservative, you may lose out on opportunities because you end up selling early. Yeah, because growth is a very dangerous animal. It really makes you look like a fool. What you thought was a sell price 6 months down the line will become a buy price after another 6 months, right? So that is the big this thing with growth. So when a company starts growing at a high, delivering a high earnings growth, many a times quantitative techniques leads you to sell quite early also. But it's not a problem with the model; it's a problem with the expectation, because you don't really want to expect something which is too high if you are too conservative. So this is just an example. I just put one small thing, whether it's a market. We learn in academics that market prices follow the Markov process with a memoryless property, and all the information is captured in the price which is there at that particular moment. But here it seems the market participants are also following the Markov process. When the earnings growth, the sales growth was 16%, median PB was about 6.4%, and the earnings growth suddenly shot up by 40%. Immediately, the price to book also upgrades to 8.9%, indicating a 20% CAGR in earnings growth. So seems the market participants are also following a Markov process. But finally, it is up to you. Because the market implied expectations has come to you. Now it is up to you to decide whether it is reasonable, whether you want to continue, or like what Mr. Buffett said, it is too difficult, let me not touch it, kind of a thing. So it's up to you to decide what it is. So putting things into practice, the last part of the presentation, you have the fundamental analysis. I say that continues to be the most important part. You need to choose the right company to get the expectations about the business right. Once you get that right, your valuation models can tell you what has to be paid and whether it's a buy or a sell or a hold or whatever it is, the valuation model can tell you. It can protect you from overpaying based on your expectations. So I have put two photos here, one of Mr. Buffett and the other is Mr. Ashwath Damodaran. I would say that the importance of fundamentals analysis and the importance of valuation, they are proportionate to the net worth of these two gentlemen, right? So the stock selection and the fundamental analysis remains critical. This is probably the second part of it. Now, the third part is about how much to buy. Because many a times what happens, investors actually spread it too thin. They are not able to really, you form an expectation, but along with that expectation, you need a conviction. And higher the conviction, you need to have a higher size of that particular position in your portfolio. So what is the, as far as position sizing is concerned, I don't think many people actually use quantitative techniques. So when I searched academic literature, of course, I came across what is called the Skelly formula. There are four gentlemen on the right side, Bill Miller, Charlie Munger, Ed Thorpe, and Pabrai. Definitely they know a thing or two about investing. And interestingly, all four of them have completely different approaches to investing. You look at Munger, he's looking at companies with moat. Then Bill Miller, he calls himself a value investor, but puts money into Amazon, making all the other value investors very unhappy, even though he says growth is a component of value. You have Ed Thorpe, who is an expert in getting the quantitative stuff right as far as valuation are concerned and deals more into derivatives. Then you have Pabrai, who talks about being a clone of Munger, but if you see his portfolio, it's a completely different approach to Munger, what you would see. So so they don't have anything in common, but one thing that binds all this for investors together is that all of them have actually advocated the use of what is called the Kelly formula as far as position sizing is concerned. Yeah, Kelly is for those who don't know, it's a pretty simple formula. That derivation is something you can even find it in Wikipedia. And if you really want to know more about what it is, you can read both these books, two wonderful books. One is Fortune's Formula and the other is Man for All Markets. So if you haven't read this, please go ahead and read. So what the Kelly formula is all about, it just says that your percentage allocation should be equal to the edge by odds. Yeah, edge is like your expected value. Yeah, so expected value, of course, it has to be positive, because if the expected value is negative, it doesn't make sense to get into a particular position. So on the left, I'm just giving an example. Suppose you have a 60% chance of a 20% gain and a 40% chance of a 20% loss. Your expected value is, say, 4%. And the odds is what is the chance that you make a gain, which is about which is that 20%. So 4 by 20 or 20% becomes the allocation that you have to give to that particular position, right? So the problem is Kelly allocation, especially when it comes to stocks and you enter into positions where your expectation of return is, say, 100 or 120% or something like that, and your downside expectation is only 20%. Your Kelly can give you a very, very high allocation. It can really make you uncomfortable. And one major assumption over here is that you are able to, in Kelly allocation, is that you are able to make similar repeated bets. Okay, so making similar repeated bets is not so making similar repeated bets is not something which is expected in the stock market, because each stock behaves in a different manner. So this is why I think in a later interview, Pabrai clearly said that the number which Kelly gave him was a pretty high number, and it's not something which should be taken at face value. But again, there is a foundation, there is a theoretical foundation to it. So how best you can utilize it from a practitioner's point of view, if you really don't want to take decisions based on your hunch and you want to have some kind of a basis to the decisions you are taking. So from a practitioner's perspective, one easy way out is to define what is known as your risk appetite, right? So what is your risk appetite? I would call risk appetite as something which you are willing to allocate when you get something which is almost like a sure shot bet, as far as stock is concerned. Like, for example, suppose there is a company growing, say, at say 15 to 20% per annum with an ROE of 25%, and the stock is available less than book value. Then how much are you willing to allocate to this kind of a company? That is what is your risk appetite. So for example, the max, it's like the maximum I am willing to allocate to a particular stock. So that is the risk appetite, right? So the position that you give for a particular stock can be defined as your Kelly allocation multiplied by your risk appetite. So in a way, you are taking that part of making that repeated bets. That part of the equation is now taken up, right? So because now you have sized the position down to say 10% or 15% or something based on your assumption. Yeah, so I'm just giving a simple example. A simple walkthrough is there. This is a company which has been generating pretty good return on equity and also growing reasonably well. I'm not getting into how much you should pay for this particular company, but assume that this company, your expectation is that this company should trade at say 3.5 times price to book value. And the company is available at say 2.2 times price to book value. You assume that there is a 75% chance that this company's price will go up to 1400. So correspondingly, you believe that the downside, the pessimistic value is say 600. So there is a 75% chance that you make a 55% return and a 25% chance that you make a 33% downside. So your expected return works out to about 33%, right? Now, if you have defined your risk appetite as say 10%, then your Kelly allocation works out to about 44%. In no way in your dreams you are going to put 44% into one stock, but 44% is the Kelly allocation, but you multiply it by your risk appetite, so maybe 4.4% is the position. If you are more aggressive and if your risk appetite is say 20%, you are willing to commit even 8.8% for that particular position. So that is the entry point. Now come to a few days later. A few days or a few months later, the stock has rallied to say market cap of 1100 crore. Everything remains the same. You have not changed their expectations. You still believe that there is a 75% chance of going to 1400, but and 25% chance of going to 600. But because the price has gone up to 1100, your expected return has now come down to 9%, right? So when the expected return comes down to 9%, your risk appetite is 10%. Your portfolio allocation will be 9% divided by 75% multiplied by 10, which works out to 1.2%. So this kind of lets you, as the stock is going up, you are able to prune your positions down. Exact opposite of what momentum investors do. You are able to prune your positions down depending upon the relative expensiveness of the stock. Right. So the advantage of this is you are able to curb your behavioral instincts to some extent, because there are two principles on the behavioral side. You have the greed and fear on one side, you have the commitment again on the same side, and again you have a principle of consistency which is on the other side. So here what you are trying to do is, once you have quantified that this is the kind of expectation you have and this is what you will do at these levels, then you are making the principle of consistency fight against the principle of commitment and greed and fear. So in a way, you are using the behavioral biases that can affect your decision making to fight against each other, which probably helps you to take a more informed decision. Another important point is what happens when you have a new stock which you identified. Very times you identify a new stock, you want to really put it into the portfolio. But if you have captured the expectations properly, you will have an expected return for each stock in your portfolio as well as the stocks which are outside the portfolio. So if a new stock has to enter, it really needs to earn its place in the portfolio, because sending something in your portfolio out and replacing it with something else, it really needs to demonstrate the expected return pattern, which needs to be very different from much higher than what is there in the portfolio. And finally, when markets are going up, everything is going up, it ensures there is a kind of an automatic cash call which you are taking without taking a conscious cash call. It's not like as and when a stock goes up, based on your expectations, you are able to prune down your allocations and increase the cash in the books, cash in the portfolio, right? So I think that comes to the end of my presentation. Of course, parting words from Mr. Peter Lynch. He definitely knows a thing or two much more about investing. He did say investing in stocks is an art, not a science, and people who have been trained to rigidly quantify everything is a big disadvantage. But still, this is a humble attempt to try to quantify something which has always remained art and not a science.
All right.
And finally, in case you haven't read, there are quite a few quantitative value investing models. A couple of them I have discussed here. There are quite a few others also. which I have captured in the book, available on Amazon. In case you find it interesting, do take a look. Yeah.
Thanks, Sharad. I think
Sorry, I think I really eaten away your time, but just went with the flow. Yeah.
it's all right. It's all right. So I think the position sizing was really interesting because I think that's not something that we kind of look at every day. We like focus on the first part and not always on the second part, right? So there were some questions in the chat, but I'll just pick up one question, before we conclude, because, like you said, we are a little out of time. So the question is, like going back to your thing about cash, right? So the question is there a portion of cash that you would consider as part of operating assets, right? So are we talking about excess cash or are we talking about cash?
Primarily, you'll have to take a look at how it has moved, because there have been situations when the cash has not really accumulated and the ROEs were high. So you can probably see what is the percentage of cash which is needed at a high ROE level, at which the company was able to sustain the operations. And then probably apply the same percentage and say what is the operating cash and non-operating cash instead of taking everything out. But mostly if it is lying in the form of investments and all, then probably they are not really needed in the day-to-day operations, I would say.
Understood. And like just one more question. So is liquidity a factor when it comes to position sizing, right? So you mentioned about conviction and expected returns and so on. Where does liquidity fit in?
As far as I am concerned, liquidity is not a factor because I still am a simple individual investor. So, but when it comes to portfolio and construction, if it comes to when you're managing a much larger portfolio, then also I don't think liquidity, because you are actually pruning the portfolio a little and taking an automatic cash call. There's something which fund managers are actually expected to do.
Yeah.
So you have two philosophies, one where you expect the investor to take the cash call and one where the fund manager to take a cash call. Depending on which school of thought you are in, if you are representing investors who are expecting you to take the cash call, then probably this will be more.
Got it. So thank you, Mr. Sharad, for the presentation and sharing your insights with us today. As a reminder to our listeners, please do complete the evaluation survey that appears on your screen at the end of the session if you haven't done so already. CFA Institute and CFA Society India members may claim professional learning credit by logging in their online professional learning tracking tool. We also have a few upcoming webinars in the chat. If you haven't registered, please do so. Our next is on the 10th of August, Career Insights, Quantitative Investing by Navneet Kumar, CFA. Thank you, everyone, for participating in today's webinar, and we wish to see you again soon. Thank you so much.
Thank you all.